Hi there, Brian here. Welcome back to the Cash Flow Desk. Today we're talking about fractional CFOs, what they are, when you might need one, and how to know if it's the right move for your business. If you've been wondering whether your company has outgrown basic bookkeeping but isn't quite ready for a full-time CFO, this video is going to help you figure that out. So, what exactly is a fractional CFO? Think of it as having a senior finance executive on your team, but part-time. Instead of hiring a full-time chief financial officer, which can cost anywhere from $200,000 to $400,000 a year, you get access to that same level of expertise for a fraction of the cost and time commitment. A fractional CFO typically works with multiple clients, spending maybe 10 to 20 hours a month with each business. They handle the strategic finance work that goes beyond day-to-day bookkeeping. Things like financial planning, cash flow forecasting, investor relations, and building systems that scale. The key difference from a regular accountant or bookkeeper is the strategic focus. While your bookkeeper records transactions and your CPA handles taxes, a fractional CFO is thinking about where your business is headed financially. So, when does it make sense to bring in a fractional CFO? There are usually a few clear signals. Your business is growing fast, but cash flow feels unpredictable. You're preparing to raise capital and need investor-ready financials. Maybe you're considering an acquisition or planning an exit, and you need someone who can model those scenarios properly. Another common situation is when you're hitting complexity that basic bookkeeping can't handle. For example, a SaaS company dealing with subscription revenue recognition, or an e-commerce business trying to optimize inventory management and understand unit economics. You might also need one if you're facing specific financial challenges, like restructuring debt, improving margins, or building budgets that actually help you make decisions instead of just tracking what already happened. The general rule is this: if you're spending more than a few hours a week on financial strategy, or if you're avoiding financial decisions because you don't have the right data, it's probably time to consider fractional CFO support. Let's get specific about what a fractional CFO actually handles. Financial planning and analysis is a big piece. Building budgets, forecasting cash flow, and creating reports that help you understand what's driving your numbers. They'll set up dashboards so you can see key metrics without digging through spreadsheets. They also handle investor and lender relations. If you're raising money, they'll prepare the financial materials, model different scenarios, and help you tell your financial story clearly. Same thing if you're working with banks on loans or credit lines. Process improvement is another area. They'll look at your accounting systems, recommend better software, and build workflows that save time and reduce errors. Think of it as upgrading your financial infrastructure. And then there's strategic support, helping you price products, evaluate new markets, assess partnerships, or plan for acquisitions. They bring a financial lens to business decisions that goes way beyond just tracking expenses. Now, let's talk about how this actually works cost-wise. Most fractional CFOs charge between $5,000 and $15,000 per month, depending on your business size and complexity. That might sound like a lot, but compare it to a full-time CFO salary plus benefits, and you're looking at maybe 20 to 30% of the cost. The engagement structure varies. Some work on retainer for a set number of hours each month. Others charge project-based fees for specific work like fundraising or financial system implementations. Many offer a hybrid approach. The key is finding someone whose experience matches your industry and stage. A CFO who's worked with early-stage SaaS companies is going to understand your challenges differently than someone who's only worked with manufacturing businesses. Most engagements start with a financial assessment. They'll audit your current setup, identify gaps, and recommend priorities. Then, you can decide whether you want ongoing support or just help with specific projects. So here's how to think about whether a fractional CFO makes sense for your business. If you're generating at least $1 million in revenue and dealing with financial complexity that's slowing down decisions, it's worth exploring. The same goes if you're planning to raise capital, acquire another business, or scale rapidly. The ROI usually comes from better cash flow management, more accurate forecasting, and avoiding costly financial mistakes. A good fractional CFO often pays for themselves just by optimizing working capital or improving gross margins. That said, if your business is still straightforward and you're comfortable with basic financial reports, you might not need this level of support yet. But when you hit that inflection point where financial strategy becomes critical to growth, having someone who can think beyond the numbers becomes invaluable. If this was helpful, hit like and subscribe. Thanks for watching. I'm Brian, and I'll see you in the next one.